Let's start with just the question that I get asked the most when people call me or DM me on like Instagram or Facebook or anything, is they ask, I want to buy a house, but I have no idea where to start. And of course, the first step is with you. So when a person calls you, what on their end should already be done or planned in their head?
Right, so typically what we are going to look for first is going to be just kind of an overall financial picture when we're trying to get somebody pre-approved. So credit is going to be a big thing. So I always, when I'm talking to somebody and we're having our initial conversation, I like to say, hey, what do you think your credit's like? Or, do you have kind of an idea? And most people do. There's apps and things like that where it may not be exact, but it kind of gives you a good idea. So I think it's probably smart to sort of know what range you're in, and, be able to kind of have an idea of where it's at, because sometimes people are like, oh, well, I don't have credit, and that's something where, typically we're going to need credit. There are options for, non-traditional credit and things like that, but there's different guidelines and stuff like that. So typically, especially since COVID and everything, which I know the world has
changed a whole lot.
Yes, the world's kind of changed a little bit, but typically the minimum credit score that we're going to look for is at least a 640. Right now, just because of that, we had gone down to 620 at a time. I think there's other banks that may even go down to 580. But the higher your credit score is, the better your rate's going to be. Kind of anything associated with the loan, if it has mortgage insurance on it or something like that, the mortgage insurance piece is going to be less. So I definitely think that you want it to be somewhere where you can qualify, but if you can have it even higher, the higher you can go, just know. Right, yeah, everything about the loan is going to be better and kind of driven based off of where that score is.
And save you money in the long run also.
Right, yeah, and so so the score, obviously, I would say that's kind of one of the number one places to start. If you think that, I'm a year out, I'm 6 months out, I'm starting to think about it, start to kind of get that in line. If you think it's something where you now need to kind of build on it a little bit, make sure your balances are low. We usually say, have it somewhere below 30% if you can. If you've got a credit card, make sure you're making all your payments on time. If you don't have a credit card and you don't really have any debt at all, look at maybe opening a small one.
And building a history.
Right. Yeah, and I always tell people, I'm like, it doesn't have to be, I know it can be scary. You don't want to just like have this huge balance running if you've never really had one before. So if you can just kind of think of it like, oh, I'm gonna, put gas on it today and then pay it off, or put my groceries on it, and kind of treat it like a game a little bit.
Just kind of building that history of, I'm able to hold my debt and manage it at the same time and not get overwhelmed by it.
Right, exactly.
And one thing is, a lot of people, they're afraid to do that if they plan on buying a home anytime soon. So as far as opening a new account, what's the time frame that's okay? So
that's kind of a hard question, because we always like to preface like I am not a credit expert by any means, but just from doing it enough and sort of seeing the trends and things like that, if you have nothing, it can take a little while to build it up. So I would definitely recommend, if you're anywhere in the ballpark of wanting to start looking at purchasing a home and getting pre-approved, at least 6 months, maybe even further, just to kind of give it time to build. A lot of people will kind of come into it and, maybe they had a student loan or something, like that, to where at least they had something kind of in their name. And then if you open that credit card, then that revolving credit is going to kind of continue to boost it, more. So you may have sort of that one thing, and that sort of helps. And then it's honestly, I think people are scared to get too much, on their plate to work on. And you don't want to have, your debt to income ratio, out of whack or anything like that with too much. But I always say, like, no credit is kind of bad credit, because you don't really have anything to prove.
There's no profile to show who you are, if you're a good a good manager of debt, or if you're a person who can't manage it. It's kind of just that the unknown. At least you know if a person has bad
Yes.
credit, you know their profile and
Yeah.
where to put them and everything.
And pretty much the main thing that we're doing is looking at your ability to repay your mortgage. So we have to have some sort of, knowledge of, okay, you pay your bills on time, you've got this one credit card, you've paid it, you've kept the balance low, you've used it responsibly. So that's kind of the big thing. And then I kind of went backwards and I mentioned debt to income ratio. But that would kind of, segue us into another big piece, which is going to be, we're going to be looking at, what your income is, your job history, things like that. So I would say kind of the next big piece is making sure you've got all that documentation ready. When I have, right. So that initial conversation again, and that's sort of how I do things. I love to have an initial conversation and just get a feel for what your current situation is and what your goals are and, what monthly payment you're comfortable with. And then that can kind of, track us into, okay, what is the purchase price going to kind of look like to get to this monthly payment that you're comfortable with? What's the loan type going to look like? What's the down payment going to look like? So that initial conversation is great to kind of find out, like I said, about the job history. So, a lot of things I'll ask is, do you know kind of what your gross annual income is currently? Where, when we say gross, that's before taxes. So a lot of times people will fill out the application and I'm like, I think there's probably maybe some more income there, and they're using that net amount.
That net,
right, their actual take home.
Actually, it's on their check that shows
the
amount that goes in their bank account, but it's actually the gross.
Right, which I think a good way to look at that is that annual number, because a lot of people are like, oh, I know they told me they're going to pay me, $50,000 like as my annual salary or whatever. And if you divide that by 12, typically you can get pretty close to that gross amount, but I don't ever expect anybody to know that exact number. And then once we are able to see a pay stub or something, then that's when we can go and verify the income. So always, so that credit piece is first, and then I'm almost always going to ask for the last 30 days pay stub. So, you want to have those ready if you're, salary, hourly, any type of job that you're going to be receiving a pay stub. And then just kind of that, documentation that goes along with that. If you've got W-2s, so typically we're going to ask for the last 2 years of W-2. So right now, for example, you probably haven't gotten 2020 yet, so we're going to be asking for 18 and 19. And then some programs allow us to go W-2 only, so we may not need tax returns. But if you do, typically it's going to be a situation where you're either self-employed, you've got some commission income, you've got some write-offs and things that we've got to look at, or 1099, like say truck drivers, a lot of them are 1099 employees, and we've got to see tax returns because they may be, writing off mileage or,
That can adjust their income. And it can have on paper that it's $50K, but if you have a certain amount of deductions, it lowers that amount that's able to count towards your mortgage. Is that correct? Right,
yeah. So, and that's the hard thing too, and kind of, going back to that is when I do kind of ask that question of, what's your annual income, and if I find out that it is something like that to where, maybe they're 1099 or self-employed or something, what they think what they make may not be what they show on paper. So that's always really important, and I always just say, make sure you kind of understand that that's something that we're going to have to verify, because a lot of times people will make, say they make 6 figures, but on paper they've written so much off, they make like 35 of what it looks like on the tax return. So that's always something really important, and I'm like, if you're just patient and you go into it knowing that we've got to verify that, it's a lot better to kind of find that out on the front end than once we're all the way through the process and then we realize that there may not be enough there.
So it sounds like it's a little bit of a balancing act between debt, income, and credit score.
Yes.
And just how those interact with each other.
Yeah, that's a good way to put it for sure, because I feel like, you may not have the highest credit score ever, but you may have really strong income, and you know, so that'll make, you know, the file look really good. Or if, you know, your income's not quite as high, but you have a really good credit score, then that may allow us to, you know, take a little bit of a higher debt to income ratio limit or something, you know, like I said, if because of that income really not quite being, you know, where you hoped it would be or something, that may allow us to get an approval because the score is a little bit stronger. So I think those are definitely, at least in my personal opinion, the main things that we kind of look at. And then of course the money that you would need to come up with the down payment and the closing costs and things like that. So that's kind of, I think that is a big, huge piece, but at the same time, there's a lot of different options out there for how we can come up with that. You know, a lot of minimal down payment options, down payment assistance programs, things like that. And I think, especially for the first-time home buyers, I think there's a misconception that you've got to have 20%, which is not true.
Yes, I get asked about that all the time from people who just are like a post of mine and come in and say, oh, I wish I could buy that house or this and things like that. And I'm always like, well, how come you can't? I was like, well, that down payment is going to be $80,000 or $50,000.
Right.
And it's like, well, that's a myth that's out there that isn't true today. It's really at a point to where 4 to 5% is able to be a down payment, or maybe less.
Right. Yeah, so there's different loan types, you know, so conventional, traditionally, that would have been the one where people were like, oh, I gotta go, you know, with a conventional 30-year, you know, 20% down mortgage. And so conventional, actually, they go as low as 5%. But if you're a first-time home buyer, there's actually an option of 3%.
Okay.
So you can even go lower than that, which is amazing. And that's been a great one that we've been able to use, you know, over the last year or so. And I don't know really how long it's been around, but it's definitely been one that's kind of come onto the scene, and it's helpful to have that option. And then, you know, the FHA loan, which that stands for the Federal Housing Administration. Don't quote me on that. I think it is, but we always just say FHA. I never say the full thing.
Yeah, we use acronyms all the time in real estate.
I know. I'm like, I'm sorry for like all the jargon, but yeah. So their minimum is 3.5%. Which is great. And then of course, if you're a veteran or, you know, even active duty in the military, there's the VA loan, and that's 0 down. So that's a great option. And then there's also a USDA loan, which we also will call them rural housing development loans. You'll kind of see it interchangeably. It's also 100% financing, but you'd have to be in a USDA eligible area. So
it's rural county, basically. And USDA, that sounds like you know that name. It actually is by the people who pack your beef. So they actually do help with home buyers who are buying houses in which would be farmland, rural America, to help push people to move out there and develop those areas and speed that up. And so they offer that assistance as well. Yeah,
I think that'd be a good way to remember it, is knowing like USDA, like farm, beef, you know.
That's where I can get this
exactly.
You know. There are 2 letters that lenders give for a proof of funds: pre-qualification and a pre-approval. In your words, what's the difference in the 2?
Right, so I would say the pre-qualification is more of an overview. So, you know, I may have gone ahead and pulled credit. I may have, you know, looked at the app and kind of ran, you know, some preliminary numbers and things like that, to where I can be like, oh yeah, you know, I think this kind of could go one way or the other, whether they look good or they don't. You know, it kind of gives me a good start. The pre-approval, for me, especially giving you that letter, because my name's tied to it, of course, is once we've pretty much verified everything. So I've already looked at the pay stubs. I've made sure that the income's there. You know, if there's any sort of, you know, something that pops up on credit that we needed to check into, whether it was like a late payment or, you know, anything like that, all of that has already pretty much been satisfied and worked through. I've looked at where the funds are going to be coming from. We've got a good game plan, whether, they are getting the funds, whether it's a gift, whether it's, they're going down payment assistance or something like that. I know that pretty much, if I'm giving you that letter, unless something crazy happens, that loan is going to close. So I feel like it's a lot more solid once you get to that pre-approval stage, because everything has been verified. It may not have actually gone through physical underwriting yet.
It's kind of been prepped for
right.
it already.
I think it's just better for everybody to know, hey, we got that pre-approval, we checked into it, and we're good to go.
So let's go back a little bit. What would they need to have ready?
So again, just kind of going back to the credit piece, have an idea of kind of where that is. We're probably going to pull credit, of course, and do the full credit check, but having a good idea of, check in, maybe if you can figure out sort of where you are there. Definitely pay stubs, last 30 days are going to be, what we're going to ask for almost immediately. That's always kind of the first thing we start with. The last 2 years W-2s. So like I said, right now 18 and 19, and then when that changes, it'll go to 19 and 20. And then last 2 years tax returns, if you've got them, last 2 months bank statements. So that was kind of when I went off into the tangent of the cash for closing and down payment and everything. We're going to be, making sure that the money's there. So based off of, whether it's a checking account, savings account, if you've got investment accounts, we can actually use, 401k if that's something that you're able to draw from. There's a couple different ways there, but depending on, where you plan to get the funds for closing, we're going to need to see, the last 2 months of those accounts. And then that is what I would say is pretty much it. Right, kind of that initial documentation that we're going to ask for, and then like I said, it can kind of segue from there depending on what the dynamics of the loan are. So like I said, if it's self-employed, there may be some more documentation there. Do you own a business? There's certain tax returns that business owners receive. We may need to see those, and so that's definitely. Like I said, that's kind of the basics of what we need, and then we can kind of go from there.
So the next thing I want to get on is the most popular website. There's a popular website out there that gives you prices on houses and how much you would pay to get inside of this house. And the website, if you take out the factor that it values houses wrong and just look at the number, that number there doesn't give you the whole picture of what the price would be. The number may be right, but it doesn't include everything that goes inside of the mortgage. And so when a person writes that check every month and mails it off or does it online or however, what all are they paying for inside of that one check?
Right. So that's a really good point, because I'll have people say, well, Zillow said it was this, and I'm like, well, I probably shouldn't have said that, but anyway, that website said it was this, and I'll have to kind of backtrack and explain, why that's not accurate. And so, when we're looking at a total monthly payment, we're including, a couple different things in that, which is going to be your principal and interest. So that's based off of, whatever the interest rate is, based off of, how much you're putting down, which makes it, makes what the principal is. And then you're going to have your homeowner's insurance monthly. And then your taxes, whether you're, say you're in the city of Memphis, you're going to have City of Memphis and Shelby County monthly taxes. And then if you don't put 20% down, whether there's some mortgage insurance on there or anything else that's going to be associated with the loan, it's all totaled in there for your total monthly payment. So I think that's where it's hard, is because sometimes those sites they may just include the principal and interest, and they're not taking into account anything else, or if they are, the estimates are way off. So, they may plug in something for homeowners insurance that's way lower than what an actual insurance agent would have quoted. The taxes are typically wrong for, I'll look at that and be like, just out of curiosity, I'm going to look, and then I'll pull them from the assessor's page and they're totally different, So I think it's really important to not get kind of like your heart set on what those numbers are going to be, because there's a lot of different factors. And even going back to the credit piece, like we were talking about, they could be factoring that on someone putting 20% down with an 800 credit score, the rate's going to be, extremely low, whereas, your rate may be a little bit higher. You may be putting 5% down, so your principal and interest already is going to be off just based off of that.
Just go through the process, person, they walk in your office or they call you right now or email you. And from the time that they meet you until the time they close on your end, what goes on?
So typically, when we first, get that call for the pre-approval and everything, we try to jump on that pretty quickly as far as, getting the full application, getting those documents that we had mentioned, up front to make sure that we can give you, the solid pre-approval. And then at that point, you go out, put an offer in, hopefully get under contract, and that can happen, pretty quickly depending on, everything, or it can take a little while, like you said, especially in this market. So we usually say the pre-approval is, is good until the credit expires, which is somewhere around, I think, 120 days or so. And, at that point we're like, okay, well, let's just repull credit, make sure everything's still good. So, we can kind of hang on to it for a little while depending on how long it takes. But if it's something where, you come to me, everybody's kind of ready to go, you get under contract pretty quickly, then typically it's going to be between a 30 and 45 day process. Could even be less if you count business days, because you're not accounting for, us working on the weekends or anything. So really, we get the contract back from you, and that's kind of when the fun starts. I always tell people, I'm like, hey, it's going to be like pretty hot and heavy in the beginning because we're getting the documentation, we're kind of getting everything rolling.
It's all time sensitive.
Right.
It's all time sensitive.
Yeah, so the quicker and better everybody can kind of work together on getting each other the documents and things, the faster we're going to be able to get it closed. Because if we're running around tracking people down and saying, hey, we sent you this, can you sign it, send it back, then it kind of gets to be one of those things where then I'm having to come to you and be like, I'm struggling to kind of get stuff, and
can we get this?
Yeah,
a document over?
Right.
We're all on a timeline, and all the different parts of people who you have to deal with to get a home. We all are on the same timeline to get that closing day done. And from the closing attorney, the lender, the realtor, we all work together in different parts, and one hold up on one part will hold up the whole process.
Right.
So to make that day, we all kind of have to get things in on time and just speak with each other and you, and a lot of it is just getting things on your end too. Yeah,
and the closing date, that's big. I mean, when we see that closing date on the contract, we are like, hey, we're going to make it, and that's kind of the biggest thing, because if that's what's in the contract, the sellers may be closing on their house, the next day, and it's all kind of like a domino effect.
It is.
So we try to really honor, hey, if this is the closing date, let's everybody work, to try to make that. And so, once we get all the documentation that we need, up front, from there, that's when, we try to get the appraisal ordered, which typically takes between, 5 to 7 business days, could be a little bit longer depending on, the volume that we're up against, which has been high lately, just with the market the way it's been.
It is.
And so we wait on that, and the file typically, will end up going to processing, and there may be a few days where not really much is going on, which I always try to tell people. I'm like, hey, that's normal. We got a lot of your stuff up front. We're waiting on the appraisal to come back. There's not really much we can do right at the moment. There are things that are going on behind the scenes that you probably don't know about, and we're just not, asking you for more documentation. There's things on our end that we have to do, and so, I'm like, don't freak out if you hadn't heard from us. Like, it's normal. And
because
so
a lot of the things that you do, as well as the closing attorney, are just behind the scenes.
Right, like title work and making sure that we're getting all that stuff, and then the appraisal will come back. That kind of will determine what happens next. Hopefully we'll have met the value and we're good to go there. If there's any repairs that the appraiser comes back with that need to be fixed, typically if you have repairs on an appraisal, they're required by the lender to be be complete before the loan closes. So you'll get them back, and sometimes they don't have repairs, and we say that's as is, which is nice. So anytime you get an appraisal back that's as is, we're like, all right, we're good.
Those are always
Yes.
They save a headache.
Yes, for sure. So so at that point when it comes back, that's kind of what we're waiting on, because then we've got to get with you and the listing agent if there's repairs to say, you know, hey, we need this fix, you know, if we can, you know, before closing and everything. And so it's almost kind of, you know, you get back to getting everybody back involved, making sure we're good there. And then after that, like I said, you know, my processor, she'll pick it up. If there's any more documentation, which this is sort of where, you know, she goes in a little bit deeper before it goes to underwriting. So, you know, if there's a bank statement that we got and there's, you know, a deposit in there that we need to track and say, you know, hey, here's a large deposit, where did that come from? We may have to source the funds. You know, basically a lot of what we do is basically just following the paper trail and sourcing everything and making sure that everything has been validated and verified and all that kind of stuff. So, you know, it's not uncommon for her to send a new list of, you know, hey, I need kind of some updated documentation on this because it may have expired, or, you know, whatever it is. Or if there was a credit inquiry that we need to make sure that no new debts were opened that we didn't account for. And then she sends it into underwriting. Typically, you know, it may take a couple days kind of for the underwriters to do it. And knowing my personal processor, she's usually pretty good. She'll send it in and she kind of like hits it on the head, and we don't typically get it back with too many things, but that's what underwriting's for. They are the ones that are like literally combing through with a magnifying glass, making sure that, you know, we've done our due diligence up front, which hopefully we have. But
Underwriters are the last.
Yes.
Who have to sign off on it.
Yes, they're kind of the last stop. So it really is kind of an assembly line. I mean, everything sort of starts with me up front and going that way, and then my processor is kind of that next stop to where she gets into it even deeper. And then underwriting is, you know, they're the ones that are checking to make sure that all of the guidelines through, you know, the investors and say Fannie Mae and Freddie Mac, you know, you've heard those terms, you know, all of those guidelines have been met to, you know, government standards and things that we can and can't do, or if there's something that, you know, we may have missed, you know, they're going to ask us to kind of go back to the borrower again if there's what they call conditions, you know, before it can close, if we need any more documentation. So at that point, once those conditions, if there are any, have been met, that's when you hear us say, you know, okay, we got the final approval, we're clear to close, you know, whatever it is, we've made sure, you know, the funds are there, everything from the beginning was still all fine. And then at that point, it goes to our closing department. They get with the attorney, they make sure all the numbers are correct, and then that's when we kind of go back to the buyer and say, here's your exact number that, you know, you either need to wire or get a cashier's check, or, you know, again, like I said, there's certain instances where they don't need to bring money to closing because so in that case, that's kind of when everything's finished, everybody goes to the closing table, everybody's happy, celebrating, and that's when we can breathe.
Yes, and that brings us right at the end of the whole process. And so I do appreciate you walking us through the start of that first initial phone call and saying, how do I get a home loan and what do I need to do? Walking us on through all the steps and briefly hitting on the different kinds of loans that are out there as well. So is there anything else you want to add on to it? Yeah, well, again, I'm Sophie Sandlin-Rains. I'm with Community Mortgage, and I'm happy to, you know, help you through the process. You know, my contact information, you can call me, you can text me. I try to be just available, you know, anytime. I know that a lot of times people are looking at houses after 5 o'clock when they get off work on weekends. We try to be available to you and your clients, you know, anytime that we can be there. And I just appreciate you asking me to do this. It was fun. Hopefully we can do it again. That wraps us up. Thank you guys for watching.
Thank you.
Preston Williams doesn't just list homes, he sells them.